Okay, very good morning everyone. This is the 19th of April and I'll be delivering the brief today. We're going to be covering sort of your global assets again. Today we're going to look at the FX market along with the equity market, which after seeing quite a volatile start to the week on Monday and Tuesday have sort of started to settle down. We're going to have a look at some of the indicators to this relatively lower volatility that we're seeing in the equity market. We're then going to turn our attention to crude, where it looks like there's a perfect storm brewing to the upside. A number of factors driving this market up, and then we're going to finish the briefing up by looking at the UK data. So if we just start off by looking at the charts, we're going to turn our attentions first to the FX market, which has been largely rather unvolatile here. So if we have a look at Eurodollar, starting off with the Eurodollar here, as we can see yesterday, this is looking at yesterday's session from here to about here. This is the dangers of sort of trading a market which doesn't really have a reason to move. We opened around this area here. We saw a blip of dollar strength taking us down to the 124 around the trend line, then about a dollar weakness taking us up, ultimately finishing exactly where we started the session. So actually the Euro-dollar currency pair made no move yesterday, so this is where sort of trading technically, trying to establish a range in which the market's going to find itself is quite important, and this trend line so far worked pretty well given the fact that it worked, was hand to hand the 124. But Euro-dollar being one of the largest trade weighted currency against the dollar is a good indication to what the dollar did on the session, but initially seeing a bit of dollar strength following the euro area inflation numbers as well, which didn't. I think the market was more just waiting for those numbers to come out just to confirm they weren't a massive beat or a miss. Ultimately, numbers came out and we saw that sort of dollar strength seep into the market before then going on to weaken. Overnight, we did see some volatility in your Australian dollar. Less jobs were created than expected, so we saw a blip lower only for it to then go and reverse itself. So again, volatile, but ultimately we're not really going anywhere very quickly, still within our sort of weekly range here. So FX markets have been a bit lackluster. One of the markets that did move, however, was the dollar yen yesterday. It was quite a tricky one here. The trend line a couple of days ago worked pretty well here, following it through, getting long S1, and then yesterday this R1 level sort of provided some near-term support with the cash open, just providing some volatility where we saw stocks go to their lows, a bit of safe haven flow, but ultimately this risk on that we're seeing in the market sort of continued to permeates the yen being sold here and just continuing its upwards trend. So quite quiet in terms of your FX space. Want to have a look at equities. This paints a very similar picture here. One of the tightest ranges I've seen, well, we've seen in the equity market for quite some time, particularly since the beginning of this volatility, which we saw back in February. Having a look at the S&P, as your sort of index, your intraday range was sort of 0.5%, so this is quite a low volatile session, and markets are just sort of starting to just consolidate after what we saw was quite a big rally after we broke out of this key level we were looking at initially in the S&P 500. A solid rally here, almost 1.5%. A bit of consolidation was due, but in terms of tradability yesterday, it was quite difficult. I think if you were going to be focusing your attention between your financials, your benchmark being the S&P, and your tech would have been the safer option given the fact that this was leading the way higher initially, and there was a opportunity here. I guess it was a difficult one because if you were being patient looking for the conservative entry around pivot, you wouldn't have got it, but the handle worked pretty well to take us down, get in long, and then a solid drive higher to sort of finish the days on its highs here. But what does this look like in terms of your volatility gauges? So this is a Bloomberg article saying is back to the days of melt-opulation for stock volatility gauges. This goes on to basically look at how volatility indexes have changed over the space of 5th of February to now mid-April, so just over 2 months, and you can see the CBOE volatility index, which tracks the S&P 500, is now down 60%. And so what is the VIX? The VIX is considered the fear gauge, so it's basically looking at the relationship between puts and calls in the market, so people are looking to protect themselves to downside. That downside demand starts to increase, the long puts start to increase in value. But right now, the volatility gauges in the S&P 500 down 60%. V-stocks, looking at your European ones, down 30%. Nikkei, so your Japanese index, down 45%. And you can see the volatility gauges are lower across the board. So this would generally mean that investors are starting to gain confidence in these equity markets, so they're not so fearful. So you're not seeing any sort of sharp selling in the market at the moment. There have been bouts of volatility, obviously, given the trade tensions, etc., etc. But things are starting to settle down. In terms of this most recent uptrend that we've been seeing, I guess there's a number of factors which are helping this along the way. So largely spurred on by the earnings. So the earnings were one of the key factors here. Easing trade tension concerns. We're not seeing as violent of rhetoric coming out of Xi Jinping or Trump regarding trade. The Syrian situation seems to have settled down. I came into this week a little bit skeptical as to whether Russia was really going to stay quiet about what happened in Syria over the weekend, but so far they haven't really mentioned anything, and I think market participants have sort of brushed that off for now. There was something along the lines, I can't remember the exact wording, but Russia said if it happens again, then there'll be an issue, which is sort of in line with what you'd expect from Russia anyway. So one of the bigger risk factors that we were seeing sort of easing away, allowing equity markets to take a bit of a turn higher. And we are hearing that Donald Trump is having very high-level discussions, whatever that means, with Kim Jong-un, and looking to have a chit-chat with Putin as well to try to ease some of the tensions that are going on around the world. So at the moment, it seems that some of the biggest risks that were in and present in the market are starting to subside. I think an underlying aspect of this is also the fact that European area inflation, this I don't think is being priced into the market just yet, but going forward, European area inflation, as we saw yesterday, was lower. UK inflation was lower across the board, well, quite dramatically. So I mean, with UK, that sort of makes sense with sterling devaluing, but with Euro area, with sort of the growth that was forecast and that we've seen, to see inflation dip a little bit lower is quite surprising. So what we may start to see is actually inflation starting to subside again. If we see that in the US as well, well then there's sort of no doubt that equities will get on the front foot. And I think me and Sam are now starting to talk about, is this the start of the recovery here to drive us all the way higher? And I think the main thing we're going to be looking for that push all the way to the highs again is going to be any sort of dovishness coming out of the central banks, especially the Fed. So looking at the market today, Sam is going to be on the mic to do technicals, but you've got quite a tight range here. I'd be looking at sort of a retracement as always before getting involved. If you're getting involved before sort of your cash open, but after your cash open, some extension trades I think are sort of fair game, given the fact that we've had this push, we've had this consolidation. The market seems to largely be settling down. Okay, turning to the oil market, which was easily one of the most volatile markets yesterday, and it was quite surprising, particularly when you have Department of Energy numbers. What would be your normal sort of price action for some of the newer guys is you would have, this is oil, this is yesterday, so what you would have is this 9:30 candle here as the API data is released. Let me just circle that up for you. So this is the 9:30 data from the APIs, which obviously sort of draw down your crude, your Cushing, your gasoline and your distillates, but only modestly so, about 1 million each. And then this sort of price action is quite normal, where the Europeans come in who weren't there, they drive the market higher, and even this one I'd sort of pin on the European traders. And that's normally the end of it. I'd say the maximum we would sort of reach is around, R2 would be if we saw an exceptionally volatile session, exceptionally bullish API data. What we saw is oil continued to rally coming into the numbers, which is quite surprising, and we're going to discuss some of the factors that led to that. But ultimately settling quite high, so we broke out of the range and settled above the range before the data even before the data was even released. And then the data was released, and just to recap what we saw crude, a drawdown of 1 million, Cushing, a drawdown of 1.1 million, distillates, a drawdown of 3.1 million, and gasoline, a drawdown of 3 million. So a drawdown across the board, which is bullish for price. You know, you have to take it relative to the APIs, but drawdown across the board is going to be bullish. But we also saw US output production fall by rise by 0.14%. Traditionally, what I would say is a rise of US production, especially when it's at all-time highs, and you're seeing United States become the largest producer in the world, should be bearish for oil prices. But this is what we were discussing before the data came out. Having seen the US production numbers come out week in, week out, what I'd say is your tolerance levels for the markets have changed. When US production was really ramping higher back in 2016, 2017, you would say that an increase of 0.2% or a decrease of 0.2% would be considered significant and elicit a market response. But as these numbers have got wider and wider and wider, you're seeing less response to 0.2% moves, and I almost feel like now an increase or decrease of 0.4% is significant. So when we got a number of 0.14%, so just over a tenth of a percent increase in US production, well, actually that's an increase of US 0.14% when oil is trading at multi-year highs. So is that really bearish for prices? Surely this is sort of an environment where you would see shale production really ramping up production as much as possible, 0.5%, 1%, 2% increases per month. And I think this may show more structural problems that exist in the shale market at the moment. There's a market which has developed very quickly. The areas of expertise, I wouldn't say there is that many people who are experts in this industry, and the people who are experts have already been sort of committed to the industry as it is, so you need retraining people to study the relevant degrees and get the relevant education, start to build more shale oil production wells, which takes time and capital. So I think maybe in terms of the capacity at which the United States can produce at the moment is being reached, and this is why we're not seeing that aggressive ramp higher in production week in, week out, because you have X number of rigs. If they're running at full capacity, or you can't hire the relevant staff or the engineers, and especially when unemployment is at record level lows, it's going to become more and more difficult to hire the right people to do the right job. And as it's a disruptive industry, there's not going to be that many people who have trained in this particular industry. If you have the chemical engineers and the mechanical engineers and the petro engineers to sort of drive this industry further anymore. So it's going to be an interesting story. Maybe we are seeing, at least for now, until we can get the infrastructure in place, or well, the United States can get the infrastructure in place to continue this ramp higher in shale oil, maybe we're capping out here. So that's one aspect that was driving the market higher. Drawdowns across the board, very minimal increase in US production, maybe showing that we're reaching maximum capacity. And just before we move on to other factors, let's have a look at where last time we were trading here. Last time we were trading here was at the end of 2014. So that's 4 years now. That's a considerable amount of time. And by the way this market is moving, it really looks like it wants to go test the $60 mark. If so, well, we wouldn't have traded at this price since 2010. So that is something to take into consideration. It's the sort of reaching the maximum utilization levels in the United States. This is where you also have to consider unemployment levels, all-time lows, so there's going to be limited staff available to drive this industry further. Other things to consider, well, Saudi Arabia for the second time mentioned oil at $80 now. The first time was significant. We saw the market rally, plus this was supported by Syrian trade tensions, and we saw us break the all-time highs. But yesterday we also saw them say $80 or even $100. Well, with Saudi Aramco's IPO coming up, I'm not surprised they're trying to talk the price up higher and higher. But even though I don't think that's the biggest contributing factor to this market going higher, I do have to say that if anybody can influence the price of oil, it really is Saudi Arabia. So that's another factor. There's one other thing with regards to Iran. This is all just building up this perfect storm scenario with regards to how oil is on such a rampage higher. Well, oil market faces a tense weight as Iran sanctions too close to call. So this is the Iranian deal struck by Obama, but now Trump is in the White House, and obviously he isn't as lenient with Iran as Obama was, and this means that the sanctions that they've put in place well, the last time those sanctions were waived for Iran, basically saying that, look, we're not going to impose any sanctions on you, were January the 12th. Now, these sanctions need to be waived again. The decision needs to be made on May the 12th, which is just under 2 weeks away. Now, if Donald Trump decides, and last time he did this in January, he said this is your last chance, Iran. I'm pretty sure on what they really want Iran to do. But this would go to say that maybe Donald Trump is not willing to waive these sanctions any further, and he's going to further impose these sanctions on Iran. Now, what do these sanctions actually entail? These sanctions actually entail that countries that want to deal with the US financial services sector, which is obviously humongous, well, they will not be allowed to do that if they have excessive trade with Iran. So to sort of follow along with, to follow the US sanctions on Iran, you would basically need to cut a lot of your imports from Iran, and obviously one of the biggest exports of Iran are oil. So if you look at how the exports were hit following the sanctions from the US, this is Iranian oil, so looking at 2010, up around 3.9 million barrels per day, sanctions imposed, and you see that this starts to fall. Production slumps. Once the sanctions are lifted, you've seen a sharp rebound in oil production. But now, if we see these sanctions once again imposed, then you're going to see a slump in the production of oil from Iran. And then if you look at the fact that with regards to Economics 101, supply and demand, if Iran stops producing as much oil, this means that there's less supply of oil, whilst we're seeing the demand side of the argument start to rise. We're seeing global growth, this synchronized global growth as it's called, continue. Supply drops, demand increases, so this further propagates WTI crude to move higher. And then there are other reports. We heard yesterday that Kuwait was discussing whether or not they wanted to discuss with OPEC members to cut production, but now you're even seeing Bloomberg report, OPEC Russian talks set to keep oil cuts even as glut vanishes. So this just goes to show that we're seeing other commentary with regards to the OPEC meeting coming up this Friday as to whether they're going to continue to cut production. So cut production further, less supply, and oil goes higher and higher and higher as demand starts to increase. And again, it's just that relationship between, do you want to sell a lot of oil at a cheap price, or do you want to sell less oil at a higher price? And it seems like what we're seeing from OPEC, non-OPEC countries is, just trying to follow on with this momentum. This market is in a very, very solid uptrend at the moment. Why not capitalize on it? Why not utilize this upwards momentum and agree to further cuts and talk up the market as much as possible, especially while we're seeing sort of US on the sort of back foot at the moment. So that then covers your oil market. So in terms of resistance, Sam's going to be on in a moment just to discuss the technicals, but the $70 mark is quite key. And that sort of wraps up your commodity and FX space. I also did forget to quickly talk about the sterling news. So let me just get the article up for 1 second. So if we have a look at sterling here, at the moment it's kind of on the back foot, but what we saw is, we saw Theresa May face a defeat in the House of Lords, I believe it was, which was the amendment pressing her to seek a post-Brexit, sorry, I've lost my words, to say whether UK is going to be able to stay in the customs union after Brexit takes place. And this is basically your pro-European individuals in the Tory party pressing that she does in fact go to seek tries to remain in the customs union after Brexit, which I think sort of causes some sort of conflict in my mind with regards to where cable is going to go. On one hand, this could result in sterling negativity, because this means that if you're seeing her face tensions and problems at the moment, and she's already faced one defeat, this means she could face further defeats, which sort of causes complications in securing securing a good Brexit deal. But on the other hand, this does support the cause for a softer Brexit. So that softer Brexit will then be positive for sterling as opposed to negative. So again, as we were discussing yesterday, this Brexit commentary is having lesser impact on the market. So this defeat faced by Theresa May should cause political instability. Our ability to be able to negotiate good terms with Europe may start to subside. But on the other hand, this does favour a softer Brexit deal. If we stay within the customs union, well, this means that we can once again, or if we look to stay within the customs union, this is not to say that she has to, it's not legally binding. But the benefit there would be is that trade continues as always. So Brexit is a source of uncertainty for businesses, but if we stay within the customs union, well, we can trade freely with everyone in the euro area. Plus any goods coming into the euro area can be traded with us quite readily. So this allows that fluidity of trade to continue, which is ultimately going to be sterling positive. So a mixed bag here, and you can see the market has largely just shrugged this off. Sterling is on the back foot. Yesterday we did find some resistance around here, and this inflation number is still at the front of everyone's mind. So, you know, it is headline news, but I wouldn't read too much into it. I don't think it's that easy to call. Sterling is on the back foot. But I would be cautious trading your cable pair today, because coming up today we have UK retail sales. So at 9:30 we have retail sales coming in from the UK. So let's have a look at your year on year, so taking out your seasonality. And let's look at your ex-fuel year on year as well. So have a look at your retail sales year on year. Consensus is for a 2% reading. So we're actually expecting retail sales to be quite high. If you can see, this is putting us at the top end of our sort of 6 months range. They were considerably high before, but we have sort of seen retail sales be lackluster for maybe the past 4 or 5 months. So 2%, we're expecting a slightly larger rebound here. If we look at our ex-fuel, I'm not sure it's showing us. Ex-fuel year on year. Okay. Ex-fuel year on year, our consensus view is for 1.4%, previously 1.1%. So both for our ex-fuel and our year on year retail sales, we're expecting a bit of a bounce higher. So we're expecting a recovery here. Now, I think the danger is we're looking at readings here for the month of March. And as we know, we had the beast from the east as well as the beast from the east times 2. And this is obviously going to affect the consumer sentiment, or how much people are going to consume. Therefore, it's going to affect retail sales. Nobody really wanted to leave the house when it was snowing, or it was -1, -2 degrees, or 1-2 degrees. And I mean, so my argument here is that we're expecting a higher reading. So we're already expecting a 2% reading. So if we get 2%, this is in line with market view. So a 0.5% recovery from last month. So to expect much more than that, if we get around the 2.4%, okay, great. This would result in sterling positivity, and therefore sterling should go up. The issue that I face is if we get a lackluster reading, so if we get to like 1.5 or 1.4, so if you see a lower reading, well, this is just going to be written off. This is going to be written off as this was the beast from the Middle East, and therefore you can't take this number literally. It's not a sign of how our consumers are feeling, or it's not a good gauge of sentiment. So I feel the larger risk in this market is to the upside. So having a look at sterling, I mean, if we get a bad reading, I do feel like we'll blip lower as the algos take on that number, but then you'll see quite a sharp turnaround in my view. Of course, take this with a pinch of salt. Let's see if the market agrees with my view, or if this is your view as well, before getting involved. But ultimately, I don't think pound will fall sharply if, let's say, we get a reading of 1.5, 1.4. It puts it at a 6 months average anyway, so that'll be beside the point. Now, in terms of where I think cable's going to go anyway, well, the reason we trade inflation numbers, we trade retail sales, we trade all of these tier 1 economic data is to sort of forecast monetary policy. And I don't really feel that this fall in inflation, yes, it's taken the pressure off the Bank of England to hike, but I don't feel like it's going to stop them hiking further as time goes on. So I think, yes, maybe today we may see some negativity following on that inflation, but I don't think this is going to be the reversing point and sterling now starts to fall. I still believe we're very much on an upwards trend, and if we get strong retail sales, I'd feel fairly confident that we may come and reverse this whole move anyway, because this doesn't change the outlook for the Bank of England. Therefore, why should it really affect the value of sterling? Let's just flick through the rest of the calendar. It is quite quiet today. We do have jobless claims coming out of the US, but of course less important. Fed's Brainard is speaking at 1 o'clock. Fed's Quarez, ECB lending. Yeah, apart from that, it's a relatively quiet data slate today. So 9:30 is going to be your main European data. So we'll focus on sterling, and then of course trade your correlated assets such as FTSE. But after that, things do start to quieten down. ADP employment change now. I think this is going to be less impactful given the fact that we just had your Canadian interest rate decision yesterday. Then wait for cash open, wait for the volumes to increase, and then look to trade with sentiment. But I feel my view on the market at the very moment is still going to be risk on. So long equities, risk on, and oil looking to test its highs as well. Okay guys, that wraps up from my end. I'm going to pass you over to Sam now, who will look at the charts a bit more technically. Thanks.
Good morning guys, just going to have a quick look over to start off. I think there's only one market in particular I want to start this off with, and that, if I put this onto a weekly chart, you can see we're just coming up here, euro against the franc, 10 ticks away from that 120, and you can see the last time that we were here, if I just draw that line, just get it pretty much right on that level. I'm sure many people remember this day, January 15th 2015. What a hold that would have been. It'd be interesting to see what happens around there. So for those looking more on an intraday point of view here, not far away from that handle, just above the R1, incredible move over the last couple of, well, three years, 3 and a bit years, pushing above there. So it'll be interesting to see what happens around there when we inevitably push a bit higher today. Euro itself though, just coming off yesterday's high, the R1, and we're coming back towards what was the previous high of the day. Pivot a bit messy, so I'd rather look to leave that alone. I think, transition, and we go back to that chart, because obviously we do need to have a look at this in a bit more detail. Yeah, done there. There you go, there's the chart, and what a one it is. January 15th, 2015. What goes down must come up, not far away, not far away at all. I put that in the chart earlier, in the chat earlier. What a move that's been, and we're not far away intraday from that point. You can see here, well, 13 ticks now, so just coming off the high, just above the R1 today, would be one to keep an eye on. FR is the futures code for that, of those people that trade that. Looking again, sorry, at the euro, which came off the high of the day, which was yesterday's high in R1. We're sort of finding a bit of support around the previous highs that you see here. I think any lower, the pivot looks a bit too messy. We've broken through it, down, up a couple of times already this morning. I think I'd rather be looking a bit lower down at the lows as the next sort of area of support if this previous high doesn't hold. You can see we did break through those highs this morning quite strongly around sort of the 8 o'clock London open, so price perhaps looking to come down a bit lower before we find support. For the pound, obviously focus this morning is going to be on the data release. How much is the beast of the east going to affect those numbers that come out on what usually is an incredibly volatile reading anyway. Price perhaps just getting squeezed in. You can see if we get a trend line here going from the 12th to yesterday's lows, and then you've got yesterday's pullback. Let me just get that level there to today's high. Probably going to get a breakout of that sort of range soon, and the data could be what takes that down. With the The pound's still near its low of the day. You've got FTSE, which had a lovely up move yesterday, and you can see breaking through the week's high, and now for this market, which has been lagging behind, I guess, some of the other equities over in the US, not far away now from that high that we had on the 26th, 27th sort of time for the FTSE. Big level. Can we close above that for the week will be interesting. So big point of interest, not far away from where we are now on the CFDs. You've got well, about 10 ticks away, so I'd have that marked up for sure. Aussie dollar breaking through to the new high this morning, which pretty much was the high that we had back on the 13th. So finding a bit of resistance there, as you would expect on the first test, but definitely a level to keep an eye on should we get another test of that area. Dollar yen just coming down, making a double bottom there, just holding off, it seems, yesterday's highs. Let me just get this trend line that I have marked up. Could be one to be aware of. You can see we broke through early hours, not too far away from where the pivot may be. So I'd be interested to see what happens around this area. I guess you're just sort of seeing it slow up a bit now, having broken through what was a decent area of support just below that R1. You can see price really look to kick on there. The dollar relatively mixed for today. Yesterday, of course, the markets, especially the euro itself, was a tricky one to trade. As you can see, it was quite a violent move down in the morning, only to recover last night, and we've already moved down and higher, and we're pretty much flat for the session, really, albeit a tiny bit up for the day. So interesting one for the dollar. Where is it going to go? I mean, I would also have this trend line on for the euro from these lows. If we were to get back down a bit lower, I think that would be a good opportunity to buy. As the euro still is, relatively, strong over the course of the year. Having a quick look over at equities, as Safe mentioned, got to favour the upside. There's always to be that sort of profit-taking scenario, especially if we have a move in the morning that's definitely increased quite dramatically. The cash open, bit of profit taking. I think you've got to prefer here to either look to get an extension of the highs when the volume's really in there, or looking for a pullback to a decent support area to continue the overall trend for the S&P, for the Nasdaq, and also the Dow. You can see for the Dow Jones, for those that do trade that S1, technically with the lows that we had yesterday and on Monday evening, marks up quite nicely, and even below that you have a good area of support from Friday's high and Monday morning's low. Definitely an area I would look to be aware of. For those that would prefer to see the highs break, I would have the trend line going from highs of the week, highs of yesterday. You see that just getting lower. You get a break of that through R1, and then those highs would come into play. Definitely something I would have in mind for later on in the day. As Safe mentioned, $70 handle, one to be aware of for oil. Incredible to think that we were in the 65s in the beginning of the week. Where is this in the grand scheme of things? Next sort of key level of resistance you've got here, the high of the December the 14th, not far away, just before that $70. So that's something I would be looking to have on the chart. That high, obviously, once the pivots are on. So yeah, around that R1, would expect some short-term resistance for now. For this market, again, preferring to look to take that long, ideally a bit lower down, but this market does seem that it's only really interested in one direction for now. Quick look over gold to wrap it up. Obviously got the data coming out in just under 20 minutes, so I don't want to take too much of your time. On the larger picture here, obviously we've been struggling, let me just put this on a week, to really push on above these key resistance levels, the 2017 and 18 high. Not a million miles away from it. I do favour the upside still for gold on a medium and longer term basis. The area of support today, the low, has been respected quite well. Whether that would still be the case if we were to get another test, I'd be probably perhaps less sure. And S1 for me with the low of yesterday looks interesting. Don't necessarily think we'll get down there anytime soon. Interesting trend that we broke, so could be looking to have a bit of support around this sort of point as we come down to test now. Let's have a look, see how that holds out for gold there. Dollar just recovering a bit literally as we speak. There you go, completely flat for the day right now, gold is. So a quick look over euro, which you can see is just coming down towards the pivot. The pound ahead of that data, not far off its low as well. I'd obviously be holding out for that, and then the FTSE as well, to see if we can perhaps look to push through the high of the 26 that we marked up on that longer term chart. Dollar yen just coming off its lower levels as well. Equities in the US just coming off their lows as well, so that double bottom there in the S&P providing good support. So I'd have the trend line from those highs as well for the US equities, perhaps focusing on the afternoon for when that would look to really come into play. Any questions, please do get them in the chat. I hope you have a great trading day and enjoy the sun. Hottest day of the year so far.